many. Now we're recording. I'll start over. Welcome
Sorry about
everyone.
that.
Welcome everybody that's attending and those that may be listening in the future to this webinar. Welcome to another installment of our Budget Hero webinar series. We're maximizing impact while minimizing expenses. As a benefit of your school's membership in your state association, you have access to many cost-saving and also transformative programs through the coalition. This includes a hybrid group long-term product from Allstate Life Insurance that also includes a long-term care rider. Now, that eliminates the use it or lose it drawback of traditional long-term care products. So I'm happy to have today Amy Eubank from Affinity LTC. And with that introduction, I will turn it over to Amy.
Thank you, Lion. I appreciate that. So I'm going to go ahead and share my screen here. Bear with me one moment. I bring up my slide deck and we can walk through this. All right, can everybody see my screen okay?
Yes.
Okay, great, thank you. So as Lion mentioned, we have a program that has been vetted and through the coalition. We've been a member of the coalition as a benefit provider since I believe 2010 or 2010, something like that. Is when we partnered up with the coalition, and it's been a great privilege to be able to offer this benefit and our previous benefits to the members of the coalition. This program is, as Lion mentioned, a hybrid product. This hybrid product, when we talk about that, it's a life insurance product. That's the chassis that it rides on. And that life insurance chassis has a rider of long-term care. Now, I do want to take a step back and let you know that long-term care as a vehicle in this country, as an insurance product, has gone through many different iterations over the years. And we've been part of them all the way through, from individual policies to worksite to true group, and also into the employer group. So with the employer group programs, as Lion mentioned, there were traditional policies out there, and they've pretty much fallen by the wayside. More and more folks are looking for something that's not going to leave them high and dry if they never need long-term care. And that's where these hybrid products come into play. This product is it came out about 10 to 12 years ago. Back then, it was purchased on an individual basis, and you had to have a buy-in of about a 5 to 6 figure dump-in. So through the years, since those years, it's been able to come down market, and Allstate Benefits has been one of the major players in the employer group market. And they sharpened their pencils for us and really gave us a really wonderful deal with this program through the coalition. So I just wanted to give you that brief overview, if you will. Long-term care is all that we do. It's right in our name, Affinity LTC. And we specialize in this program. We've enrolled well over 150 private colleges and universities all across the country. We are incumbent broker friendly. So if you do have that broker relationship and you'd like them to be included in talking through this process, we are more than willing to have that conversation with them and include them. We would be the front persons as far as making sure that Allstate puts down everything that they're promised to us through the coalition program. But again, very incumbent broker friendly if that's your situation. So with this program, I'm going to go through some specifics. And during this entire thing, I'm going to illustrate and iterate the differences between this product versus a traditional long-term care policy that you may be more familiar with. Number one is the fact that you as the institution, you get to choose whether or not you want to put in a universal life product or a whole life product. One or the other is what your choice is. And I will explain in more detail here in a little bit exactly where most of our schools have been going recently and the reasons behind that. So you as the employer make that decision, universal life or whole life. I'm very thrilled to let you know that this does have guaranteed issuance. This program is more geared towards your employees themselves with a spousal benefit as well. But we've not been able to say guaranteed issuance for anybody regarding long-term care for well over 12 years. So for me to be able to say, I can get your employees guaranteed issuance up to $175,000 worth of coverage, that's a huge deal. And when I'm talking about this guaranteed issuance, I mean true guaranteed issuance. The only question that is asked of the employees is whether they use tobacco or not. That's it. So folks that are on staff that have chronic health conditions, say they have MS, for an example, somebody that's actively at work but has that medical condition, they're uninsurable out on the street. Folks with height weight issues, their BMI is out of whack, they're uninsurable out on the street. Both those folks, somebody that's literally in a wheelchair right now and is receiving care and is on staff at your university or college, can get this policy with $175,000 worth of coverage, guaranteed issuance. So that's unbelievably important for me to make sure that I stress that, and we're very excited about that. Spouses, working spouses can get up to $40,000 worth of coverage. Non-working spouses can get up to $10,000 worth of coverage. There is a child term rider in the program that you can be included or can be stripped out, whichever you prefer. It has nothing to do with long-term care. There is no benefits there. It's simply a goodwill gesture. And again, those kids are guaranteed issuance as well. So you can get them $20,000 worth of life. And when they reach maturity, they can transfer it automatically with no evidence of insurability into a universal or a whole life product. So it's just a goodwill gesture of being able to offer it. There is something that's very unique, excuse me, with long-term care insurance. Traditionally, it's a one-time deal. We enroll the program and then it moves into what's called ongoing status. And that ongoing status is, so your underwriting concession is for the first year. And then an ongoing status, if somebody wants to join, they can do so, but they have to go through underwriting to do so. Usually with a traditional product, we only have one bite of the apple with a guaranteed issuance or an underwriting concession. So with this program, one of the things that's really great is you have an initial enrollment in year one. Say this fall, November, you decide you want to enroll the program. No problem. We'll move forward and make that happen. Then next year, year two, we'll come back around and ask you if you'd like us to re-enroll the program again with full guaranteed issuance to everybody on staff. So that's very unusual. After year two, then it goes into ongoing status. New hires coming on board at any time, those folks, you give us the information, we load them into the system, and they have 30 days that they can apply with guaranteed issuance. And those going through life qualifying events, those are also guaranteed issuance. One of the wonderful things with this program also is the fact that this is a minimum participation of 5 issued applications per employer group. We can do that standing on our head with guaranteed issuance. That is never a problem. So having a minimum participation of just 5 applications is a huge thing. The 3-year rate guarantee, that's for, then this is one of the things that's different between a traditional long-term care policy and these policies. When these policies are issued, because they're on that life insurance chassis, again, those policies with this program, when I pick my policy and get my premium, that's my premium moving forward. Long-term care, traditional long-term care insurance policies are always subject to having rate actions at a later date. And that's something nobody likes to talk about, but it happens, and all carriers have experienced that. One of the benefits, again, of having this on a life insurance product with a long-term care rider is the fact that when the policy is issued, that those are your premiums moving forward. Now, there is some differences between that. But the other thing is a 3-year rate guarantee. So that is on the employer side of things. And that 3-year rate guarantee means that if we enroll this program in 2024, and say 5 years from now, you've done your 2 enrollments, it's an ongoing status, et cetera, et cetera. And 5 years from now, you turn around and say, you know what, we've had a lot of attrition. We think we want to re-energize this program. Will the carrier allow us to re-enroll the program with guaranteed issuance again? And the answer is probably going to be yes, they'll allow you to do that because they're looking for more premiums to come on the books, of course, and have more insureds. So the 3-year rate guarantee, where that comes into play, is after your program's enrolled, if the carrier were to change the product pricing, in other words, going through the insurance regulations to get all the product refiled with all the states with new rates, if you're outside that 3-year rate guarantee, they can quote that new enrollment at their new rates. Okay? Everybody that's currently in their program, they're going. They're just grandfathered in. But it's only if you're going to have that re-enrollment way down the road. So just want to make sure that everybody's good with that. So the program itself, again, is life insurance coverage. Employees can choose in $25,000 increments from $25,000 to $175,000 worth of coverage. So it's not a cookie cutter. Everybody gets to choose what they want to do. Excuse me. Working spouses can get 10, 25, or 40,000. And again, that's all with guaranteed issuance. Non-working spouse, 10,000. And the child term life rider, they can choose to add them on at $10,000 or $20,000 worth of coverage. Excuse me. On the right-hand side are alternative benefit riders. Those riders are such that they are state-specific. So if you want to know if they're available in your state, we can check that out. Those riders are ones that we do not typically include in our program because, frankly, most folks are looking to skinny down their premiums. They only have so much disposable income at the ready, so we don't often include those. And by the way, those riders, if you choose to include them, that means it's automatically included on everybody's pricing, so everybody's pricing goes up. It's not like the employee can choose to have that rider or not. That is an employer decision. Just making sure of that. The riders that I'm talking about and where our concentration are, the two on the left-hand side of the slide. The first one's pretty straightforward. It's accelerated death benefit for terminal illness. If I buy a policy, let's say for the sake of round numbers, I buy a $100,000 policy, and I am diagnosed with a late-stage diagnosis and I'm terminal. I can pull 75% of my death benefit, in my case, $75,000, can be paid out to me in cash, tax-free, and I can do with it whatever I want. I can pay for my bills. I can pay my medical bills. I can pay for my medical care. I can go to the track and bet it on the ponies. I can go on a humdinger of a vacation. Whatever I want to do with those funds, I can do. Upon my demise, the other 25% of my death benefit is paid out to my heirs. So that's the first rider. But our main concentration is the accelerated death benefit for long-term care. And how this will work, and I'm going to show you a slide in just a moment here that's going to explain this in a little bit more detail. Excuse me. But it's a monthly advance of 4% of my death benefit for up to 25 months. And a lot of folks go, whoa, what, just 25 months? I'm going to explain that in a little bit more detail here in just a moment. But let's take a look at some of the facts regarding long-term care. There is a 70% chance that if you reach age 65, you're going to need some form of long-term care sometime in your lifetime. A 70% chance. That is an alarming statistic. That's why it's important for your employees and you to consider this type of benefit. On average, folks are needing care from 2 to 4 years. That's the average claim. And that is something that is a statistic, and it's out there. It's been gone over. Now, of course, you have folks that unfortunately get sick and die within 6 months or 2 weeks. But you also have folks that linger in nursing homes, depends upon your family history. But the average is 2 to 4 years. So when I talked about that 25 months there just 2 seconds ago, 2 years slides right in there into this average. A lot of folks also think that Medicare is going to pay for them. They're like, well, you know what? I'm going to be 65 when I need my care, and if I need it, Medicare is there. I'm here to tell you that Medicare is not going to be there. Medicare is very hard to use for the long-term care benefit. In fact, it used to be, and I'll have to look again, your Social Security statements used to say right on them, if you're looking for long-term care coverage, look for your own coverage. The Medicare does not pay for it. Medicare has very strict criteria. First, you have to be over age 65, and you must be in a hospital for at least 3 days. Upon leaving that hospital, you must enter a facility for your care within 30 days. And then Medicare will pay the first 100 days. Days 1 through 20, they pay everything. Days 21 through 100, you pick up a copay. And after day 100, Medicare cuts off. So Medicare is not a viable option for most people. So these are some of the reasons that you need to consider this benefit. How you trigger the benefit for the long-term care is the standard tax-qualified benefit in the fact that if you need care for 90 days or more, that's the definition of long-term, 90 days or more. So that's not, oh, I broke my leg and take care of me for 6 weeks while it heals. No, you need to be in care for at least 90 days. And you need assistance, either hands-on or standby assistance, with 2 of your activities of daily living. Now, they're all listed there, but think of them this way. We did 5 of these first thing this morning. We transferred. We literally got out of bed, moving your body from place to place, took care of our toileting needs, got a shower, got dressed, and got something to eat. That's 5. The 6th one is maintaining continence throughout the day. So if you need assistance with 2 of those, that triggers your benefit. Or if you have a severe cognitive impairment, that will also trigger your benefit. Folks with senile dementia or Alzheimer's might be able to do those activities of daily living, but they might not do them appropriately, and they need supervision. So a severe cognitive impairment will also trigger your benefit. Once you've triggered your benefit, there is a 90-day elimination period. Think of it as your deductible. It's how long you might have to pay out of pocket before your benefit gets paid out to you. Again, that's 90 days that you're going to need the care and the 90-day elimination period. Kind of keep that in your mind. And I say that you might have to pay that out of pocket. If you're in a car accident and you're going to need care, your insurance is going to pay a portion of that time frame, if not all of it. Or maybe you have a stroke. Again, you're going to be under health coverage from the time that you initially had that stroke. Your clock starts ticking on day one. You may be in care with your health insurance taking care of you through that time frame. Or if you just age into care, you might have to pay that out of pocket. Excuse me. This is a qualified plan, and it is very comprehensive in the fact that no matter where you want to receive your care, you can do so. So you can have care delivered in your home, non-confined, or an adult daycare, or you can be in an assisted living facility, a nursing home facility, or even memory care, which is what Alzheimer's units are called now. So no matter where you're receiving your care, you can be paid your benefit. Now, the only qualification is if it's non-confined, you need at least one visit a month to get 50% of your benefit, or 2 visits a month for 100% of your benefit. And that's only for the non-confined care. So if you're having a home health aide come in and take care of you, assist you 2 days a week, that's more than enough. You're qualified right there. Now, as I had mentioned before, there is, for folks that are uninsurable out on the street and they're getting that guaranteed issuance, there is a caveat. Of course there is. There's always a caveat. But this one's pretty easy to satisfy. Pre-existing condition limitation. This policy has what we call a 6-6 pre-X. And that's dealing with the 6 months prior to the effective date of your policy and the 6 months after the effective date of your policy. So for round thoughts, let's just keep this policy effective date in my scenario as January 1st of 2026. If I'm one of those persons that's uninsurable and I buy this policy and I have MS, for example, I'm actively at work, no problems. You run this program this fall and I jump all over it. I'm going to buy as much as I can afford because I have guaranteed issuance and I'm uninsurable. So I buy this policy. If at any time in the first 6 months after January 1st, 2026, I access my policy, in other words, I put a claim in, Allstate reserves the right to pull my medical records and look in them from the 6 months before my effective date, so June 1st of 2024, and they can look in my records and see if I was cared for or have mention of my MS, if that's what my claim is for. If I do so, they're going to preclude me from using my benefit for that condition because it was pre-existing. Now, here's where the cool part is. If I claim July 1st next year, 6 months and 1 day, or any time thereafter, I'm golden. They're paying my claim, no questions asked. I've gone outside that 6 month window after my effective date. So that's where we really make sure that your folks are aware of this, and we really urge them to seriously take a look at this because they can't get this out on the street anywhere. Now, as I said earlier, I wanted to give you an illustration of how you can use your policy. Excuse me. And as Lion had mentioned, this is a policy that does not have a use it or lose it scenario, which a traditional long-term care policy does. Traditional long-term care policy, even if you have a return of benefits, a return of death, that's only going to return your premiums. This has a true death benefit. So if I buy my policy, in my example here, we have John. John buys a $100,000 policy, and he never needs long-term care, and he dies. His heirs get $100,000. Contrary to that, on the other side, flip the coin the other way, if John needs long-term care, he can pull $4,000 a month for 25 months off of his policy, and his entire benefit can be paid out to him for his long-term care. If you die after that, there is no death benefit because you've exhausted the policy, you've used it all for the long-term care. More commonly is a benefit split, where John needs 6 months worth of care and then passes away. So he uses that $4,000 a month. Again, that 4% is pulled off of his policy. He gets that every single month for 6 months here for $24,000, and then he dies. His heirs still receive the residual death benefit, $76,000. So it's a true win-win-win, and all the wins are John's. Because no matter how you look at this policy is going to pay out to someone, either to your heirs or to yourself through your benefits. One of the things that I want to make sure that I'm mention is when we're talking about this $4,000 in this scenario, excuse me, say I'm receiving care in my home and it's only running me $2,000. This is a cash indemnity policy. It's paying me a check. Once I activate my policy, I am automatically getting a check for 4% of my death benefit, $4,000 every single month. What I do with that is up to me. What we recommend, and we recommend this in our educational meetings with your employees as well, is if I do receive care in my home and say it's only running me $2,000 a month, I pay the bill with the $2,000 that I've received, and I take the extra $2,000 and I sock it away in my checking account. And then after I've, quote, exhausted my benefit, I have a little nest egg sitting over there that I build up, and I can use those funds then, in this case, $50,000. If I use that benefit the whole way through and exhaust, I got an extra $50,000 sitting over here that I can use for my care. So again, it's a true benefit that's being paid out to you. Now, I wanted to explain a little bit about the differences between the whole life and the universal life product. The differences are quite easily explained in the fact that when we look at them, whole life is guaranteed. Guarantees, guaranteed, guarantees. Universal life is more flexible. And there's a major difference between the two. The whole life endows at age 121. You stop paying premiums at age 95 and it matures or pays out irregardless at age 121. So if we would happen to live that long, I'm going to get a check in the mail for $100,000. Excuse me. The universal life product pays up and endows at age 95. So it's just something to be aware of. Most people in care are in care by their 80s, usually. So having a policy that endows at age 95 is not that much of a difference. So the flexibility of the universal product is what we are concentrating on. We like the guarantees, but the guarantees come with a price tag. Let me show you what those are. So we did just samples here, and this says sample rates, and these are the current rates that are on the books for this product. By the way, every age has its own premium. It's not age banded or anything like that. So a 36-year-old, a 37, et cetera, their premiums are all in there. But we wanted to do a quick snapshot. And we want to pull out the premiums, and we just gave an example of $50,000 and $75,000. If we look at the $50,000 premiums on the left-hand side there, and we look at a 45-year-old, which is the average age of our clients, a 45-year-old can get the whole life, and where we're looking at that is there's GUL 23 Target, GUL 23 Max, and GWL. So the UL 23s, those are both the universal products, universal life product, and then the WL is the whole life. So you can see that the whole life product is double almost what the universal target premium is. We are encouraging our clients to move forward with the program with a target premium in mind. And the reason being, you get the biggest bang for your dollar. When I'm talking discretionary income that I'm using to pay these premiums, I want to get the most value that I can for my dollar. And I can do that through this target. The max premiums there for the UL, those are the most funds I can put in on a monthly basis into that policy and not have it become a modified endowment contract, a savings account, if you will, in layman's terms. So we concentrate, and our clients are moving forward with the UL target premiums because, again, we want to make sure that we're using our dollars wisely. So if you would decide that you wanted to take a look at this program, the next steps, and that's here on another slide or two, we have a sold case document. It's an employer agreement that you sign off on saying, yes, XYZ institution is going to move forward with the program, and we would like the universal life product, and we move from there. So we get that documentation, we send that into Allstate, and that puts them on notice. In a 6-week ramp up from start to beginning, we can have this program up and running, which is pretty impressive. There is a kickoff call in the first week after we get that document so that we can talk to you and talk to the folks at Allstate, make sure everybody's on the same page. This is the open enrollment. This is what our communications and our strategies are going to be. By the way, I wanted to mention, and I forgot to mention this earlier, this benefit can be set up direct bill. So, or if you really want to, we can do payroll deduction. That's up to you. The employer gets to make that decision. So I can tell you that 95% of the people that are currently enrolling in our programs are choosing to do direct bill because, especially after the pandemic, more and more folks are just used to having those automatic bank drafts come right out of their accounts anyway, and they're more comfortable doing so. So, and let's face it, it's one last reconciliation that you need to worry about in your department. So take that administrative burden off of you and just set them all up on direct bill. But again, if you want to do payroll, that's fine. If we don't need payroll, then we can skip that week 2 billing call. Week 3, we send out a bunch of information to you. We send some templated emails that we brand up for you. We have, at that point, we've set up a series of Zoom webinars that we would do. The enrollment itself begins in week 4 or week 5, and that enrollment is a 4-week open enrollment with a 2-week extension. And during that open enrollment, we will be more than happy to provide you with paper brochures if you'd like us to, so flyers, etc. We also have everything in PDF format, whatever works best for you. We have the website that is driven in for you, is personalized for every institution. We have posters if you want to do, a lot of folks are not doing paper anymore. They want to do as much as they possibly can green, which is great. We do have emails. Again, the email campaign, we ask you to send 5 different emails out to your folks during set times throughout the enrollment. Like, hey, the program's going to start. We're launching this date. Here's the webinar, Zoom meetings, dates and times, etc. We'll also come on campus and host educational voluntary group meetings on your campus across 2 days. So we're willing to do that, and we'd either myself or my colleague Julie Clevenger would do that. We do need a census in week 3. I skipped over that, I forgot right there. There is a census provided for Allstate that is plugged into their system, and It's not as comprehensive as your health insurance census that you would provide, but it does have data on it as far as name, address, dates of birth, dates of hire, etc. And it makes the employee experience much better when they go to enroll online. And then when they enroll online, we utilize Allstate's Bencell system. It is a secured website. The employees log in. This is actually the login page that they would see. They log in with either their employee number or their social security number, whichever you choose. Most of the employers are using an employee number. And then a PIN. And the PIN is the last four of the SOCH and the last two of your birth year. And then they can enter the program. They verify whether or not they use tobacco, and they can take a look at their rates. And again, pick and choose. It's a simple click of a button to purchase this policy, again, because it's guaranteed issuance. So that's a really great thing. Once employees are enrolled, they have a mobile app that they can go on. We try to keep the footprint out of your office, to be honest with you, as much as we possibly can. So we are also available for conversation. We can walk folks through their enrollments directly. We'll set up a Zoom. We can share screens and see exactly what they can share and see exactly what we're doing, and enroll them directly into the program. Again, once they do have the policy, they can go through the My Benefits program and download the app on their phone or their tablet, or go in through the web and see exactly what they have. It's not uncommon for folks to forget about, hey, I have that long-term care insurance benefit. And they walk into your office and say, can you tell me about what I signed up for? This is your opportunity to either direct them to us and we can assist them with that. They can call the customer care number, or you can say, did you download the app on your phone, and here's how you get into it. But that's what we're here for. Our contact information is all over our communication pieces so that we are truly your liaison in to the carrier. So next steps, if you'd like to take a look at this program and see what it looks like specifically for your institution, just reach out to us, send us an email, and say, hey, we'd like to take a look at it. We'll have a proposal generated. We would do a proposal review with you. It's a 44-page document that you get back, and we just do a quick 15-minute call with you to make sure that, to hit the highlights, this is what you need to be looking at. And when you get into the myriad of rate tables, because we're going to show you universal life and the whole life premiums for everything. So we'll show all of that data, and we want to make sure that you're looking at the proper pages when you're looking at the proposal. Then you can turn around and say, yes, we would like to move forward, or let's sit on this for a little bit. I think you'll find that our firm is one of the most laid back companies out there, as far as we do not hound people. Julie and myself, by the way, when we're on your campus and enrolling programs, we are salaried employees. So your employees are not pressured by us in any way, shape, or fashion as far as enrolling. Hey, did you enroll yet? No, that's not our style. We like to truly take that educational approach and make sure that they know exactly what they're purchasing and what they would like to see. Are there any questions? I know I just threw a whole lot of information out there.
Amy, seeing no questions, I'd like to take this opportunity to thank you for the presentation today. Thank everyone for attending, and remember, be a budget hero. Attend our next edition of Maximizing Impact While Minimizing Expenses, our Budget Hero webinar series. Thank you for today. This will be available on recording. And with that, have a good afternoon.
Thank you, Lion.